Hello students and good day to you all. Today is the 4th of December 2017 and this is our weekly market review. Now you'll have to excuse me, I caught some cold last week and I assume that next week it will all be over. But for today I'll carry this analysis with what we've got. So going back to our sidekicks, the trading station, and today we're going to look at what we had last week. We practically had movements against our analysis, but just a bit, and we're already in our trades. And I'm always saying that when we've got counter trend movements, that is a good potential to rejoin a specific trend. So if you had problems to join the trades that we took last week, you can make your assessment during this week and locate for potential trades. Again, I'm talking to our students because in this case you need to know what tools we're using in order for you to make the right assessment. But generally, let's look at what we've got in the market. So let's just maximize the screen, and I'm going to look at the dollar index. So we've practically received a very nice downtrend since our entry point over here, and you can see that the market is practically fluctuating at the moment. Our assessment is indeed to see a continuance of a downtrend movement that will continue the general trend that we've talked about. Let's look at the larger image on the daily chart, for example. So again, based on that, we can still see the potential of receiving a full ABC downtrend structure. Now, as I told you, everything can happen in the market, but this is the highest potential that we've got in the market right now regarding the dollar. What will cause the dollar to lose such strength? I don't really know. We've got a lot of announcements that we'll analyze later on, but for now, we've got a potential of the dollar to express additional weakness. We've talked a bit about the dollar Japanese yen. Again, we can see the same idea that during last week, the market bounced backward and practically gave us another good entry point for additional downtrend. That is my point of view for this specific structure that we're seeing over here. Sometimes when you see a huge movement like this climbing up and dropping down with a major pullback and a continuance of an uptrend, it's a bit difficult for us to understand what is the inner structure. So in order for us to do that, we need to go to a lower time frame, 15 minutes for example, and we can see that we've got a full corrective pattern. It's a bit misleading, this structure. I would definitely say that we're looking at an A wave, a B wave, and a C wave, when the B wave is a triangle. Okay, and we've got a very nice completion of a corrective pattern with a potential to see additional downtrends from this structure specifically. Now, some traders will place a trend line below this entire structure. I would say that it will take too much time until we will see the market dropping down and crossing this level. I would even, with my analysis, take the risk potential of trading in this specific structure below this entire C wave, and crossing that obviously is already allowing me to take the trade. Let's look at a higher image of this. So we've got the 1, 2, 3, 4, 5, an entire structure over 5 waves. We've crossed the downtrend bit, and we've got a very, very close downtrend movement potential and a stop loss at the top of the C wave. Very, very small potential for a trade. Just an example, with a very, very small amount of risk and a very large profit potential, at least until the trend line. Even if the market will decide to bounce on the trend line below, still we've got a very nice downtrend movement over here. And in terms of scale, we're talking about risking 0.16% in front of 1.2% profit potential, and that's way more than what we need in order for us to see substantial profit on our account. On a higher scale, again, we still see a potential of this ABC pattern to complete its structure. I remind you, I said that I see a potential of this being the A wave, an extended B wave, and we've got a potential to see a continuance of a C wave. Let's give a target for this specific structure. So in terms of potential, we know that our assessment is that the A wave equals to the C wave in terms of length. So we're looking for the 100 level that we've got over here, meaning that our assessment is to see the market dropping down toward the 104 level on the dollar versus Japanese yen, meaning long-term investment. I'm talking about several months of trade potential. Equals 7% of a downtrend movement, 700 pips. It's a very, very nice target potential for this specific structure. And again, if we're taking a long-term investment on this chart, then we're practically risking something like 1 or 2% of our leverage trades, depending on your account size and ability. So regarding the dollar versus Japanese yen, we still see a potential of a downtrend movement, and it correlates with the potential of a weaker dollar in the market. We're practically looking at the same image again and again and again every week, because analyzing several assets that correlate toward the same direction, it shows that we've got some base for our analysis. Again, I'm always saying we've got the market is changing constantly, and we need to be open with our perspective, meaning that we need to observe what the market is allowing us to receive from it. And if right now, for example, we will have conditions with the Federal Reserve, problematic relationship between Janet Yellen and Donald Trump, potential of raising the interest rate or lower potential for raising the interest rate or changes in the United States, then that will affect the dollar specifically, and we will need to consider this potential. But for now, no question about that. Our goal is for a weaker dollar in the market, and we're looking for a potential to express that on a variety of assets. Now, just a bit about correlation. Very nicely, we can see that the Australian dollar and the New Zealand dollar are correlated. If I'll zoom out just a bit, talking about structures generally, what we can see over here is an impulse movement, a strong liquid movement, and a corrective pattern. No question about that. We've got a completion of an A wave, a B wave, and a C wave. Now, what does that mean? Right now, we're looking at the Australian dollar in front of the US dollar, meaning that the downtrend on this chart equals a weaker Australian dollar and a stronger dollar. So let's think about that. Why does it happen when we've got a stronger dollar on the in front of the Australian dollar, a stronger US dollar in front of the Australian dollar, and we've got a weaker dollar in front of the euro and in front of the pound and in front of the Japanese yen? It's not a question about why. Why is not the right question over here. The question is, why do I invest in the dollar in front of the Japanese yen when I've got the Australian dollar, which is obviously weaker than the US dollar? While the dollar is losing strength on other areas, still it's gaining strength in front of the Australian dollar, meaning that the Australian dollar is significantly weaker than the Japanese yen and the euro, which are gaining strength in front of the US dollar that is gaining strength in front of the Australian dollar. It's a cycle. It's a closed cycle, and we need to understand that in this case, the Australian dollar possesses a better probability to produce a profitable trade when it comes down to expressing it in front of the entire market. Again, not in front of the US dollar, because we see the US dollar with a weakening potential, but in front of other assets such as the euro and the Japanese yen and the pound as well. We've analyzed that last week, and we saw the potential of them gaining strength in front of the US dollar. Looking at the New Zealand dollar in front of the US dollar, you can see that we've got a very, very equivalent point when it comes down to the Australian dollar in front of the New Zealand dollar in terms of structure. Again, let's just look at the general trends. Australian dollar in front of the US dollar, you can see a major downtrend movement and a corrective pattern. The same thing goes for the New Zealand in front of the US dollar, a downtrend movement and a corrective pattern. So let's think about the background. And I've talked about with our correlation sessions, I've talked a lot about the idea of correlation, and I gave these examples, but let's try to do that today with the information that we've got right now. The Australian dollar and the New Zealand dollar, they are active approximately at the same time at the beginning of the trading day or at the beginning of the trading week generally. And we can see that they are being affected under the same forces. And again, they are closed. Their markets are closed during the US market time frame, and they are open partially during the European session. So we know that they are being pressured by the same effect when it comes down to different time frames during the day. But we also know that they are presenting a specific agenda, an extended world agenda, which is far from the US market, which is far from the European market. And we know that this effect is taking place at different time frames. So they are better when it comes down to handling crisis on the global scale. For example, let's say that right now we've got weakness on the European market. This weakness is moving forward to the US market. Okay, but when the European market is closed and the US market needs to handle the funds, the capital on its own, he's able to stabilize the condition. So next day, when the Australian market will open or the New Zealand market will open, we will see a minor effect of the initial crisis on the European market. So we can say that the gap between the different markets, the end of the US market's time frame and the beginning of the Asian market generally, or specifically the Australian and New Zealand, we can say that this gap is allowing the Australian dollar and the New Zealand to avoid participating in minor crisis during the day, an in-a-day crisis, let's call it like this. And in this case, we know that this market is separated from the other markets in terms of the time frame and in terms of the gap that is allowing it to separate its expression. So it's very, very, very important to analyze the New Zealand dollar and the Australian dollar in addition to the euro and the US dollar, or the European market and the US market's time frame, because it's a cleaner perspective. It's a cleaner perspective. It shows us just what is the leftover of the market, not dealing with an inner structure of a crisis. And that completes our analysis. Generally, we're still looking for potential of the weaker dollar in the market. We saw an example of how not focusing on the dollar, but receiving all the information from the dollar. Right now, we know that the Australian dollar is in a potential to express additional weakness, and the euro and the pound and the Japanese yen are in a potential to gain additional strength during this week. A very good entry point for this week. I wish you all the best with your trades. Have a pleasant week, and bye-bye.